A rental car sits idle for 16 hours a day. That's the problem nobody talks about. When you rent a car for $60 a day, you're not paying for the vehicle itself. You're paying for the risk of ownership spread across hundreds of rental days per year. A rental company buys a sedan for $25,000. It needs to recoup that cost, plus maintenance, insurance, and labor, all while the car depreciates. The math is brutal. A car that sits unused generates zero revenue but costs money every single day. This is where fleet management becomes the real business. A rental company doesn't just own cars, it manages when they are rented, where they are parked, and how long they sit. Major chains track every vehicle with GPS. If a car in Denver isn't booked, they'll move it to Denver International Airport where demand is higher. This logistics problem is why enterprise companies employ thousands of analysts. They're solving an equation: minimize idle time, maximize utilization. But here's what nobody expects. A renter crashes the car. Insurance is the second pillar. Every rental company carries massive liability coverage. When you decline their damage waiver, they are betting you won't hit anything. When you accept it, you're paying them upfront to absorb that risk. That waiver, often $15 to $30 per day, funds a claims department that processes thousands of accidents monthly. The waiver is profitable because most rentals have zero accidents. Then comes dynamic pricing. You've noticed the same car costs $40 on Tuesday but $120 on Friday. This isn't random. Rental companies use algorithms that track demand, competitor pricing, and seasonal trends in real time. Spring break, prices spike. Hurricane season, demand shifts regionally. The system learns: book early, you pay less; book last minute, you pay the scarcity premium. It's Uber's model applied to steel and rubber. The feedback loop is tight. High utilization rates, cars rented 80% of the time, mean lower per day costs. But that requires aggressive pricing during off-peak hours to fill seats. A $35 rental on a quiet Monday is still revenue. That's why some companies offer aggressive discounts. They've calculated that a $35 rental beats a $0 rental, even after accounting for fuel, cleaning, and wear. The model works until it doesn't. During the 2008 recession, rental companies had overexpanded their fleets. Demand evaporated overnight. They were stuck with thousands of cars they couldn't rent, couldn't sell quickly, and couldn't afford to hold. Some analysts saw it coming. They tracked utilization rates and noted the decline months in advance. The collapse wasn't surprising. It was inevitable, written in the data. So when you pay $89 for a rental, you're not just renting a car. You're paying for the logistics network that moves it across states, the insurance pool that covers accidents, the algorithms that price it, and the utilization math that keeps the company solvent. Each dollar is divided between depreciation, fuel, labor, capital costs, and profit. The system is fragile. It depends on consistent demand and the ability to sell used cars at predictable prices. Break either assumption, and the whole model unravels. The car rental business is, at its core, a bet that you'll return the car on time and without damage. Everything else, the pricing, the fleet, the insurance, exists to manage that single risk. Understanding that changes how you see those rental counters. You're not renting a car. You're participating in a system designed to predict your behavior and price accordingly. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to explore the hidden systems that power everyday economics. New deep dives every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.